Michael Burry, renowned for his astute financial forecasts, recently made headlines with a substantial bet against the stock market. While mainstream media and the Twitter community have sensationalized the story, the reality is a bit more nuanced. Burry, who earlier this year deleted his Twitter account, revealed in his Q213F filing two notable put option positions against the S&P 500 and the NASDAQ 100, valued at $887 million and $739 million, respectively. At first glance, it appears to be a massive bet against the market. However, these figures represent the total market value of the shares he hedged with put options, not the actual amount invested in the options themselves. In reality, the cost of put option contracts is significantly less than the stocks themselves. Hence, the true extent of his investment is less than what the headlines suggest. Burry bought put options against 4 million shares, 2 million each of SPY and QQQ, amounting to 40,000 option contracts since each contract represents 100 shares. Looking at the put option contract prices on Yahoo Finance with expiry dates about a month away, the costs vary, significantly lower than the SPY share price, currently around $450 per share. The big question is, how much exactly did Michael Burry bet against the market? Unfortunately, we can't ascertain this. The 13F reports only tell us the number of option contracts purchased and whether they are puts or calls, but they don't provide details on strike prices or expiry dates. These factors greatly influence the cost of purchasing a put option. The closer the strike price is to the current share price, the more expensive the option, as it's more likely to be profitable before expiration. Similarly, options with longer expiry dates cost more, as there's more time for conditions to materialize. Thus, Burry could have made various moves: a small bet for a significant market decline or a larger trade betting on a smaller drop. Moreover, we don't know the time frame he's betting on. With options reported in the 13F filings, we simply lack enough data to conclude anything beyond the fact that Michael Burry is indeed making some bet where he'll profit if the S&P 500 and NASDAQ 100 fall in value. As is often the case with Michael Burry, it's hard to draw strong conclusions from his 13F. While he has a value investor's mindset, he likes to engage in short-term trades. He moves in and out of the market so frequently that, because 13Fs are released 45 days after the quarter's end, we can't even be sure he still holds these put option positions. It's quite possible that he's already sold out of them and moved on to something else. Now let's pivot to the changes Michael Burry has made to his equity portfolio. This is where the plot thickens. While he's betting against the S&P 500 and the NASDAQ 100, he's simultaneously adding a multitude of individual stocks to his portfolio. Indeed, the strategy seems paradoxical. He added 25 new stocks, bolstered 3 existing positions, trimmed down 3, and completely sold out of 15. This represents a significant turnover in his portfolio. Interestingly, the total investment value at the end of Q2 is almost identical to that at the end of Q1. It appears he's strategically replaced a number of stocks with others, showcasing the maneuverings of a trader's portfolio. To put this into perspective, consider Warren Buffett's 13F history. Buffett's investments demonstrate remarkable consistency, reflecting his long-term investment strategy. In stark contrast, Michael Burry's portfolio is a study in variability. The only consistent feature is its inconsistency. This pattern in Burry's portfolio raises intriguing questions. What drives his decision-making process? How does his trading strategy align with his market predictions? As we delve deeper, we'll explore the rationale behind these frequent changes and what they could signify for the market's future. Let's approach Michael Burry's seemingly contradictory moves in his latest 13F filing with a critical eye. On one hand, he's betting against the stock market, yet on the other, he's actively purchasing 25 new stocks. This initially puzzled me until Hamish highlighted a crucial point about the composition of the S&P 500 and the NASDAQ 100. Take a closer look at the weightings of these indices. The major players are Apple, Microsoft, Amazon, Nvidia, Meta, Google, and Tesla. Collectively known as the Magnificent Seven, these companies have significantly influenced the S&P 500's rally throughout 2023, predominantly fueled by speculative hype around buzzwords like artificial intelligence. What seems to be Burry's strategy here is a calculated short-term wager. He's speculating that the current market hype, driven largely by AI and these 7 tech giants, won't endure. Considering these companies collectively account for about 27% of the S&P 500's weight, a loss of momentum could potentially drag the entire index down, especially impacting the NASDAQ 100. Conversely, Burry is also spotting and capitalizing on individual opportunities, which explains the addition of 25 stocks to his portfolio. This dual strategy of shorting and buying suggests a nuanced approach to the market, balancing the general skepticism about the tech-driven hype with a keen eye for other profitable ventures. In Q2 2023, Michael Burry made a significant shift in his portfolio strategy, notably exiting from his positions in Chinese tech stocks, specifically Alibaba and JD.com. These stocks were substantial components of Sion's U.S. stock portfolio at the end of Q1, accounting for 20% and representing his top 2 largest holdings. There was a prevailing thought that Burry might maintain these positions, given their persistence in his portfolio across multiple quarters and his previous dealings with both companies. However, this speculation proved incorrect. Burry's decision to sell off these Chinese tech stocks likely still resulted in a profitable outcome. JD.com, although roughly breaking even, was hovering around its 2022 low price in the second quarter. More notably, Alibaba's stock experienced a substantial rally, soaring up to 60% higher from its Q4 low in Q2. This move raises questions about Burry's outlook on the Chinese tech sector and his overall investment strategy. Did market dynamics, regulatory concerns, or other factors influence his decision to divest from these significant holdings? Let's find out. Shifting our focus from Chinese tech stocks, another notable action by Michael Burry in his recent portfolio adjustments was his exit from U.S. regional banks. These stocks faced a tumultuous period earlier this year, with several banks experiencing significant challenges due to deposit withdrawals. This situation led to a widespread sense of fear and uncertainty in bank shares, an environment that Burry leveraged to his advantage. However, Burry's approach wasn't to place his bets on just 1 or 2 regional banks. Instead, he opted for a basket bet, spreading his investments across several banks, including PacWest, First Republic, Huntington Bancshares, New York Community Bancorp, and Western Alliance. This strategy, while theoretically sound, yielded mixed results. First Republic, for instance, was a definite setback, and Huntington Bancshares also likely resulted in a loss. On the other hand, Western Alliance probably broke even, while PacWest and New York Community Bank could have been profitable ventures. Ultimately, Burry chose to close these positions and move on, indicating a shift in his investment strategy or risk assessment. What does this decision reveal about his outlook on the U.S. banking sector, and how does it align with his broader market predictions? Let's find out based on Burry's new buys. In the latest quarter, Michael Burry made several intriguing new investments, particularly in the travel sector. Notably, he bought stakes in Expedia and MGM Resorts International, Expedia, a conglomerate of online travel brands including Hotels.com, Vrbo, Orbitz, Travelocity, and others, has now become the largest holding in Burry's portfolio, accounting for 9.82% and valued at around $11 million. Additionally, Burry invested in MGM Resorts International, a major player in global gaming and entertainment, owning 17 U.S.-based casinos, a 56% stake in MGM China, and the online gambling site Leo Vegas. Beyond these, Burry also made significant investments in Charter Communications, Generic Holdings, and CVS Health. A common thread among these businesses is their relatively low price to free cash flow multiples, indicating Burry's continued inclination towards value investing. Expedia and CVS both boast price to free cash flow multiples of 7, while Charter's stands at 10. Further down the list, Stellantis is at 5, Vital Energy at 4, and Warner Brothers at 9. These investments reflect Burry's classic value-oriented mindset, despite his tendency towards short-term trading. Many of these stocks are considered classically inexpensive, aligning with his value investing approach. However, as always with Michael Burry, there's a caution against drawing too many conclusions. Instead, we might view his choices as an ideas list for potentially undervalued businesses worth exploring. What do you think about Michael Burry's Q213F filing? Share your thoughts in the comments below. If you enjoyed this video, please leave a like and subscribe for more insightful analyses. Stay tuned for the next video where we dive deeper into the world of investment strategies.